Welcome to the Deep Dive, where we get straight into the key earnings calls you need to know about. Fast insights, that's the goal. Today, it's West Bank, ticker EWBC. They just dropped their Q3 2025 results after the bell.
And it landed right in the middle of a pretty jittery week for regional banks, didn't it? Lots of nerves out there.
Definitely. Questions everywhere about credit, funding, the usual suspects.
Right. But EWBC, they came out swinging. Management kept calling it a record-breaking quarter.
And you saw that reflected sort of in the after hours. The stock ticked up a bit.
Yeah, a modest bump. Positive, but cautious maybe. Investors liked it, clearly, but maybe still worried about the neighborhood these banks live in.
Exactly. So that's our mission today, right? Figure out why EWBC managed this performance and, why the street might still be holding back just a little.
It really feels like a story of, let's say, solid execution. Quality winning out when things get tough. We need to see if their strategy really holds up under the microscope.
Okay, let's start high level. The headline numbers, because this wasn't just scraping by.
No, not at all. This was pretty comprehensive, a real beat.
So GAAP EPS, that's the standard accounting earnings per share, came in at $2.65.
Which sounds good, but put it in context. The consensus estimate, what analysts expected, it was around $2.35, maybe $2.36.
So that's what, like a 12% beat? That's huge.
Almost unheard of, yeah. And even their own adjusted number, the non-GAAP EPS, was strong at $2.62. Just serious momentum there.
And that momentum carried through to revenue too, right?
Absolutely. $778 million in total revenue. That beat expectations by about 7%.
But the growth rate itself stood out to me, 18.3% year over year.
Yeah. Getting double-digit top-line growth like that in this banking climate, that's saying something. Very differentiated.
So how did they pull it off? Where did that strength come from?
Well, you don't get numbers like that by accident. And if you listen to management, the core story here, it's really built on their deposit franchise.
Deposits, okay.
They kept pointing to it, saying it funded their loan growth. Sure.
Yeah.
But maybe more importantly, it helped them, optimize their funding mix, get the right kind of funding.
Right. So was it just bringing in more money overall or something specific about the type of deposits?
It's the type. This is where you see the quality.
Yeah.
Yeah. Total deposits were up $1.5 billion quarter over quarter. Solid growth.
Okay.
But the key detail they highlighted, non-interest-bearing deposits, NIBs, the free checking account money.
The best kind, sticky and zero costs.
Exactly. That grew faster percentage-wise than their time deposits, like CDs.
So they're replacing potentially expensive, maybe flighty money with cheap, stable core funds. That's textbook franchise strength, especially now.
Textbook. And that strength, that funding advantage, it sets them up strategically heading into 2026. They talked about this huge amount of time deposits, CDs, that are maturing soon.
How much are we talking?
$18 billion with a B over the next 6 months. So Q4 this year and Q1 next year.
Wow, $18 billion. That's a massive lever they can pull.
It really is. They've laddered it out. So and it's still an if, but if those Fed rate cuts everyone expects actually happen,
they're perfectly positioned. They can roll those maturing CDs over at much lower rates, presumably cheaper funding.
And that cheaper funding flows right to the bottom line. It directly boosts net interest income, NII, the core profit metric, what they earn on loans minus what they pay on deposits.
Speaking of NII, they hit a record there too, $677 million.
They did. Record number. Now, there's a little asterisk there.
Okay.
About $32 million of that came from discount accretion and interest recoveries. Thanks. Basically collecting on some older troubled loans they'd already marked down.
So like a one-time bonus kicking in.
Kind of, yeah. A nice little kicker. But even if you back that out, adjust for it, the NII was $645 million, still an all-time high. The core engine is definitely running strong.
And this ties back to how quickly they react to rate changes, right? They mentioned their deposit beta.
They talked about their down cycle beta for interest-bearing deposits, 0.62 over 125 basis points of Fed cuts.
Okay, break that down. What does 0.62 beta actually mean for listeners?
It basically measures how much of a Fed rate cut they actually capture in lower deposit costs. So a 0.62 beta means for every 1% the Fed cuts, they expect to lower their interest-bearing deposit costs by about 0.62%. It shows how quickly they pass those savings through.
And they seem pretty proud of their speed there.
Yeah, they made a point of saying they now reprice deposits literally the night the Fed makes a move. Super fast.
So they get that cost saving on deposits almost immediately.
Right. Before the income side, the loan yields fully adjusts down. So there's this brief period, like in Q4 they expect, where they get a little NII boost from that timing difference.
Interesting. Okay, moving beyond interest income, fees looked strong too. Non-NII revenue.
Yeah, really strong. Bolsters the quality of the revenue, makes it less reliant just on rates. Fee income hit a record $92 million. That's up 13% year over year.
And it wasn't just one thing.
No, broad-based. Wealth management, foreign exchange, FX, derivatives, all categories grew.
Wealth management stood out though, right?
It really did. Fees up 36% year over year. That's huge growth. Management said it's payoff from sustained investment, hiring good people, and really focusing on cross-selling, deepening those client relationships.
Seems like that investment is paying off. Okay, let's flip to the cost side. Expenses. Because great revenue doesn't help if costs run wild.
True. Total operating expenses were $261 million. Now, that number includes a specific item they called out.
What was that?
A $27 million one-time compensation charge. It was related to an equity award change for employees eligible for retirement.
Is that really one time, or is it maybe masking some underlying wage pressure? Always have to ask that.
Fair question. Management frames it as non-recurring. And maybe the market buys it, because look at the efficiency ratio.
Right. What was that number?
Even with that $27 million charge hitting the expenses, the reported efficiency ratio for Q3 was 35.6%.
And remind us, what does 35.6% mean in plain English?
Super simple. That means for every dollar of revenue they bring in, they only spend about 36 cents on operating costs.
Which is really good in banking.
Elite, yeah. Anything below 40% is generally seen as top-tier discipline. And management basically said, look, we're okay if expenses grow high single digits, if we keep getting that double-digit fee growth. They value those recurring fee streams, so they're willing to invest, but clearly making sure it pays off.
Makes sense. They also mentioned some longer-term investments, building out capabilities.
Yeah, specifically in FX and payments. Sounds like some new wire payment solutions are starting to roll out late this year, Q4. But the full integrated foreign exchange platform, that's further out mid to late 2026. They're playing a long game there too.
Okay, long game on tech. But the immediate concern for everyone right now is credit quality, asset quality. How did they look there?
This is the area causing all the heartburn across the sector, right? But EWBC, they look frankly very resilient.
Okay.
Numbers.
Net charge-offs, actual losses were really low, just 13 basis points, about $18 million. And the money they set aside for future losses, the provision, that actually went down this quarter.
Down from Q2. Yeah, $36 million this quarter versus $45 million in Q2. That's usually a sign of confidence from management about the loan book.
What about problem loans? Non-performers?
Stable. Very low at 0.25% of assets. And the loans they're watching closely, the criticized category, that actually declined down to 2.14%, driven by improvements in CRE and residential mortgages, the areas people worry most about.
So credit looks solid, even improving in spots. But you mentioned something interesting about their reserves earlier.
Right. This is kind of fascinating. Even though credit performed well and the provision decreased, they actually increased their total allowance for credit losses. The overall cushion.
Increased it. Why?
It went up to 1.42% of loans from 1.38% last quarter. And they were clear. This wasn't because of specific bad loans popping up or worries about, say, tariffs hitting customers. It was driven by their economic modeling, things like unemployment forecasts, GDP growth expectations.
So it's a macro overlay, a bit more caution about the general outlook for next year.
Exactly. Proactive caution, building an even bigger safety net despite current strength.
And that safety net is built on a strong foundation already, right? Capital levels.
Oh, yeah. Their main capital ratio, tangible common equity or TCE, is sitting at 10.2%. That's way above the minimums regulators require.
It's like having extra armor plating.
For sure. And management sees that high capital level as a weapon. Helps attract talent, reassures big customers, signals stability in a shaky environment.
And are they putting that capital to work for shareholders? Buybacks?
They are. Repurchased $25 million worth of stock in Q3. That signals management thinks the shares are undervalued, and they still have $216 million left on their current buyback authorization. So expect them to be opportunistic there when they're allowed to trade.
Okay, so strong quarter, solid credit, good capital. How did this all translate into their outlook? Did they update guidance?
They did. Upgraded it, actually. Confirms the momentum. For the full year, they now expect revenue and NII growth to be better than 10%. That's a clear positive revision.
And the credit outlook.
Also improved. They tightened and lowered the range for full-year net charge-offs. Now expecting just 10 to 20 basis points, de-risking the outlook there.
But guidance always depends on assumptions. What are they assuming about the Fed, about the economy?
Good point. Their base case guidance embeds 2 more Fed rate cuts happening in Q4 this year.
2 cuts in Q4, that seems optimistic, maybe. What if we only get 1 or none? How much does their story depend on that?
It's definitely sensitive. Those rate cuts fuel the NII benefit from the deposit repricing we talked about. But, the core franchise strength is there regardless. They still benefit relative to peers, even if cuts are slower.
What about loan demand? Are businesses and consumers borrowing?
They said residential mortgage demand is holding steady. Commercial real estate, CRE, is actually showing some signs of life, interestingly.
Did they say what it would take to really get CRE moving again?
Yeah, they offered a specific thought. Management suggested maybe 100 basis points of total cuts from the peak might be needed to really unstick that market.
So if those 2 Q4 cuts happen,
that gets you closer. Could spark more activity, more opportunity for them. And regular commercial lending, C&I, that remains steady. Things like private equity capital call lines are holding up well.
So the big picture story they're telling.
It's really about this deposit franchise just compounding value. They're heading into 2026 looking strong, while maybe others in this sector are still dealing with funding pressures or credit cleanup.
Okay. That sets things up nicely for our next segment. Time to talk about a potential market idea based on all this. But first, the necessary disclaimer.
Loud and clear. This is not financial advice.
Nope. We are not brokers, not advisors. This is purely for educational discussion, thinking about market dynamics. Don't run out and do this trade.
Please don't. It's just an exploration of a plausible, maybe slightly aggressive idea based on EWBC's performance relative to the sector.
All right, disclaimer delivered. What's the potential angle here? What tension does this data create?
Well, it really comes down to that divergence we talked about. It feels like the market might be undervaluing EWBC's specific advantages.
Like what specific?
2 main things. First, that huge $18 billion CD repricing wave is coming over the next 2 quarters. That's a massive, predictable funding cost advantage kicking in right when rates might fall. Second, their demonstrably superior asset quality. They just lowered their loss guidance when others are still cautious.
And they've already started to outperform the pack, right?
Yeah, if you look over the last year or so, EWBC stock is up maybe 8%, while the main regional bank ETF, KRE, is basically flat. There's already separation.
So the trade idea is betting that gap widens, a relative value play.
Exactly that. The concept would be a relative value trade. You'd go long EWBC, buy the common stock, or maybe use long-dated call options for leverage.
Okay.
And you'd fund that position by taking a short position in the S&P regional banking ETF, KRE. Sell the basket, buy the standout.
So you're betting EWBC's execution, its capital strength, and especially that liability-sensitive balance sheet benefiting from cuts will let it keep pulling away from the broader, more cautious regional bank group.
Precisely. You're isolating EWBC's perceived strengths against the sector's general weaknesses or uncertainties, betting on continued divergence.
Interesting idea. Again, not advice, just a thought experiment. So wrapping up the quarter for EWBC, record earnings, record revenue.
Driven by that deposit momentum.
Right. And strong credit, good capital, strategic deployment. Looks like they're set up pretty well for 2026.
Yeah, position from strength. Which leads to maybe a final thought for you, the listener, to chew on.
Okay.
Given how strong their capital is, that 10.2% TCE ratio we mentioned, and how consistently profitable they are, they run around an 18.5% return on tangible common equity, which is excellent.
Meaning they make great returns on their core capital.
Right. So the question is, if loan demand stays just moderate next year, how much of that excess capital and profit are they going to return directly to shareholders through bigger buybacks, maybe higher dividends?
They certainly have the capacity. How aggressive will they be in deploying it?
That's the question for 2026. They've got the firepower. Now it's about how they choose to use it.
A great point to end on. Fantastic deep dive today. Thanks for walking us through those numbers.
My pleasure.
And thank you for joining us. We encourage you to take this information and continue your own deep dive. We'll catch you next time.